Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closures and our Money Mondays webinar here for our coaching students. And I've gotten a lot of questions over the last few weeks, especially it's been interesting as people get into the first of the year. They're wanting to make good returns. They're wanting to get started investing. They're wanting to take action. And if you've been through my workshops or you've been to at least my Note weekend, you always know that I'm telling you, hey, get out there and network, get out and talk to people locally or online. I mean, especially if you're not going to go do it locally in person, you got to be online. You got to be sharing information, sharing how to really capitalize in today's market and what you're focused on. And I don't care if you're selling, investing in tiddlywinks, crypto, or whatever it is, you've got to be out there sharing what you're looking for and telling people what you're looking for. But I've gotten questions from investors like, well, Scott, how do I make money as a note investor? How do I make six figures? Because I don't want to go from my job paying me 50 grand a year, create another job that's just going to pay me 50 grand a year. And I'm like, I totally understand that. All right, totally understand that you don't want to do that. So I wanted to go back in. I've kind of every year we usually record this kind of episode because it's always a good thing. How to make six figures as a note investor. All right. And six figures is just the starting point. Okay. That's all you're going to make is 100 grand. That's it. We've got quite a few of our coaching students are making $250,000 a year and more. Because if you're going to do something, it should do something that makes money. It is not too much work. And this has a way of really helping you to do it passively. Yes, you've got to do a little bit of work. You've got to kind of log in. You've got to spend some time finding deals. You got to spend some time marketing. If you don't have your own money, you got to really market for private capital. But this is not a difficult concept. And this presentation is one of those favorite things. Now, I've tweaked it a little bit. If you've heard me talk about how to make six figures or how to make 100K as a note investor and watched before, I really want you to hang around because, yes, a lot of it's similar things. But the very end, I literally went out to a platform, pulled a list available today that you all could purchase today if you had money. Okay. If you don't have money, you can still use OPM, pay them a good return on their money, IRA investors, friends, families, and stuff like that, and still put six figures in your pocket on an annual basis on almost a passive level with performing notes or non-performance. I like non-performing because it's higher returns, but there's great ways still to make double-digit returns in the performing paper side, especially a couple different ways to do it. So I'm excited about this episode. I'm excited to share with you. Look, there are no dumb questions. If you're watching this live or watching this on the replay or joining me live in Zoom as one of the WC Income members, ask questions. That's the only way that you're going to get educated and understand how to do the voodoo that we do. All right. Good morning, Paul. Good morning, SK. Good morning, a lot of other folks out there. I see we've got a good group joining us online here. So let's get into it. Let's talk to how you make some bank as a note investor and why I think it's the sexiest side of real estate. Okay. Um, and it's important for you to understand, ladies and gentlemen. Will this happen overnight for you? Probably not. This is not a get rich quick scheme. This is a build wealth strategy that if you stick into it and use it, you totally can do this and really change the way your life is, change the trajectory, and get rock and roll. So let's dive into this. So anyway, so first and foremost, it says making six figures in 2024. I got to tweak the slide. But anyway, you get what I'm saying. In the next 12 months, let's break it down to basics, okay? Let's just assume, and I'm just saying assume, that you need 5 grand in cash flow per month to cover your bills, okay? Not five. Well, Scott, 5 grand times 12 is only 60K. Yeah. Just chill with me for a second here. I'll discuss this and just follow me on this. So 5 grand per month, just a base. If you need 10 grand per month, it's 120 grand a year, then just double these numbers. All right. Now, one of the great things about what you're going to want to do is you're going to target assets, whether you're using your own money or using other people's money, assets with at least a fair market value of 50,000 plus. Okay. 100,000 plus. Okay. Doesn't matter. Whatever you want to set your base, your floor level of assets, I wouldn't go below 50. So that's why we're doing it 50. Okay. Now, if you're buying non-performing notes at roughly 50% of fair market value on a one-off basis, which is about what you would see on a $50,000 asset, you pay about 25. Okay, 25K for it. That's kind of normal. We're still seeing stuff like that, especially if they're non-performing, that's occupied, that can get back on track. That's a big key. Okay. You want them to be occupied. It gives you the most amount of flexibility. Okay. Plus buying at the 25K and 50, that gives you plenty of money. If you have to foreclose, you've got money to foreclose and make money as an REO sale or do some like upkeep and then still sell it and make a profit. Okay. Obviously, we want to see where rent rates are higher than existing payments. That's pretty much the case now these days. In some cases, rents can be lower than existing mortgage payments, but it's preferable if rent rates are high, because that's the thing is if you're dealing with owner occupied, they're already looking to see what rent is if they're behind on their mortgage payment. I had a conversation with a guy today who was called in and was looking to potentially modify his loan because he'd been out of work. And I'm like, well, what's market rent? Well, market rent's a lot higher. I'm like, well, then there's not really a lot of room for me to justify reducing your interest rate, reducing your payment, because it's already about 60 cents on the dollar of rent rates. If you get foreclosed on, you're gonna go pay a whole lot more. Okay. And this is a base model. I only say this because you want your payments to be at least probably in the $500 range, $500 in a month range. Sometimes lower, sometimes it all varies how the mortgage is structured. But that's kind of the numbers that we're going to run off of here. Yeah, sometimes it could be under that at 400, sometimes it be over that at 600 or 700. I mean, we had a coaching student bought a note the other day, a week ago today, actually closed on it. The monthly P&I on it is $792 a month. He paid $35 for the deal, and the house is worth $70. Okay, so these are very feasible deals that we see all the time. All right, now when you buy these notes, it's not to foreclose. When you buy these notes that are owner occupied or have tenants in it, part of the servicing side is to reach out to these borrowers and say, hey, let's get you back on track. You're behind by more than 6 months or greater. That's why we get a bigger discount. Let's get you back on track. Can you bring 4 months to the table for us to do a forbearance agreement, loan modification kind of aspect to allow you to get back on track? So 4 months of back payments at $500, that's basically about $2,000 you wanted to bring to the table. That's not a lot. Okay. If somebody's going to get up and move, they're going to spend more than probably $2,000 on moving costs, deposits, and all that fun stuff that go along with it, right? Give or take a little bit. All right. And here's the thing. Well, Scott, I don't have 25 grand. I don't have 100 grand. Well, okay, that's fine. You're going to use OPM, other people's money, okay, investor money, and you're going to pay them anywhere from 6 to 12% to purchase the note. All right. And the reason we say 6 to 12% is because when you're talking to these investors, you don't want to just go out and offer them 12%. Yeah, some people, yes, we have it 12%. Others, we have it 6%. This is why we teach so much in our day 2 about the conversation, the mental side of the money raising side, and asking potential investors, IRA investors, hey, what's that money been doing? Where's it been sitting? How's that performed for you? If they're getting 0% on their money, it's been sitting there for 2 years, don't give them 12, give them 6. You can always increase it later on deal number 2 or deal number 3 to see if they're a good fit. But if they haven't done squat with their IRA funds in 2 years, then don't go out and give them 12%. Okay, because they could, if they want to find 12% or greater, they really need to go do it themselves. Okay, but I'm just giving you that scenario. So let's just say we're getting it low. Okay, if you borrow $25,000 at 6%, okay, that's basically 6% is just flat interest only. You're paying $1,500 per year out to these investors, and that's $125 per month if you break it, $1,500 divided by 12 months. Okay. Now, if you're going to get $5,000 in cash flow, and the monthly payment roughly is $500 at minimum that we're looking for, you take the $125, that comes to $375 a month net to you. Well, if you divide that into 5,000, that equals roughly about 14 deals. It's like 13.3. Okay. But we round up because you're not going to do a third of a deal. Okay. You do 14 deals. All right. Okay. So 14 deals. And just so you know, 5,000 by 375 is 14. What's 375? Well, that remaining $125 is being paid to your investor on a monthly basis or quarterly basis is what I would prefer. Okay. Now, if you do that in a year, $375 a month times 14 deals times 12 months, that comes to $63,000 in annual cash flow on the front side. Okay. That's the pay-in monthly basis through a servicing company. Okay. Now, One thing we didn't add to this was that extra $2,000 at a minimum. Okay. So if you take 4 payments of 500, that's $2,000 skin in the bank that goes into your HIT National Bank. All right, right here. From your bar to modify to forbearance agreement, stuff like that. And then if you take that 2,000 times 20 times 14 deals, that's $28,000 in income that goes to you off of that. So if you add those two together, 63,000 plus 28,000 skin in the game, that's $91,000 in income just off basically the buying side. I'm buying a non-performing note, and we're getting the borrower back on track. Now, here's the great thing. Yes, not every borrower is going to perform, but if you're coming to somebody who's occupied and they're living in the property, you're going to probably be able to get them back on track about 70% of the time. All right. Especially if it's in fast foreclosure states, definitely. If it's a longer foreclosure state, they may drag it out, but that's going to happen. But still, if it's occupied and you look at the servicing notes, you can find people that will want to get back on track pretty relatively easy. True story, able to do that. All right. Now, moving on. If you want to let's talk about this. So you buy these notes, you get them reperforming, and you want to sell them all off. Well, if you bought 14 assets at $50,000 in value, I'm obviously going to be probably more than that, but let's just do that, okay? That's a $700,000 portfolio that you're holding in fair market value, okay? The UPB is going to be greater than the value, so they're a little upside down, but still you're sitting in a good spot, okay? Remember, you're only at 50% of the fair market value or UPB, whichever is less, right? So 25,000 of what you paid purchase price of notes times 14, it comes to $350,000 funded. The funding partner is getting, remember, 6 to 12% payments that you're making out to them quarterly. All right, not once a month, but quarterly. All right. So how do you return your investors' principal if at 12 months they want to get back out, if you get the bar back on track? Okay, well, the great thing is once you have a borrower who's made 12 months of on-time payments or 12 months of performance, that's a re-performing note, okay? That's reconsidered a performing note or re-performing note. 12 months of on-time payments from skin in the game, why not? They're committed to staying back on track. Whatever kind of hiccup they got into on the front end, guess what? They're here for the long term in a good way, okay? Now, you can sell your re-performing note now at 80% of fair market value. Remember, the UPB is a little bit higher, so at roughly 80% of the fair market value. Now, if you're buying loans where there's equity, you wouldn't be paying, you'd sell at 80% of basically the legal balance in that case in a lot of cases. But for what we're trying to make here is underwater notes, okay? So you sell it at 80%. Well, if you take that 80% and multiply it times the $700,000 portfolio you have of those 14 notes at 50,000, that comes to $560,000 in note sale proceeds. Okay, that means you sell them all, you get 560 in, you pay back your investor or investors the 350 you borrowed at 6% or whatever it is. Remember, they're getting their monthly interest paid back to them. So guess what? You would then net, all right, 560 minus 350 comes to a whopping $210,000 plus in note sale proceeds. Now, if you add in the $63,000 in monthly cash flow you've gotten, plus the skin in the game from these 14 borrowers, that's a pretty good chunk of change. That actually comes to $301,000 in total income. Now, this is gross. Well, that's grossly high. I'm trying to be as conservative as possible with these guys, going off of raw numbers. When I looked at back at portfolios that we've bought, yeah, 500 plus was where the numbers came in. 500 was basically the minimum number in a lot of cases. Now, there's notes that if you're using your own money, you can go higher or lower, you can be differently here. But the idea here is that you're paying somebody else's money. Now, if you're using your own money on this, guess what? You're netting in that cash flow on a monthly basis. You don't have to worry about splitting it with anybody else. Okay, your ROI is higher. You're not have to pay back your investor because you're paying back yourself, basically, and still making a great return. Okay? So the ROI on this is actually to you is infinite because you didn't use your own money. Your investors made 6% or greater, whatever you wanted to pay them. And that's a great thing. Flat interest rate loans, and you still got plenty of money there at the end for it. That's a pretty good day. That's a pretty good 12-month salary. Can we agree to that, ladies and gentlemen? A chunk on the front end with skin in the game, monthly cash flow, and boom, a big payout in approximately 12 months, give or take a little bit. So let's say that Say it takes you 18 months to sell your notes. Okay, it sells 18 months. So you're making 100 grand net every 6 months if it takes you 18 months. Okay. Just to give you a little bit of an idea on that. All right, let's move on here. Now, what does the funding partner get? Well, your funding partner is just getting a flat return on investment. They're getting their 6 to 12% on a quarterly basis. If it's in a self-directed IRA, it's going in passively. They can't be active. It's a beautiful thing using IRA investors, okay? It's not paying zero to them, and they're not getting a negative return with costs and things like that. It's actually putting some money into it, and that's a great way to get the ball rock and rolling. Savings and CDs are paying less than 1%, often 0.01% right now, unless they put in 100 grand and tied up for 10 years. This is what your competitive is. This is what your competition is, CDs, okay? Now, if an active investor comes out, well, I want to make 12% or greater, and I'm like, well, what have you done? Well, I'm fixing properties, I'm private lending. Okay, then you're probably not a fit for what I'm trying to do. I'm looking for passive investors who want to make it above average return than what they're used to getting, okay? And you're not doing these long-term deals. You're doing 24 to 36-month deals. That gives you time to get them back on track and turn around and sell them all off. Biggest mistake I made was setting up my agreements at 1 year initially. Get it done, and just drags that a little bit. But that's the thing. You're doing short-term 24 to 36-month deals, not 30 years. All right. When people start talking about mortgages, oh, I'm going to be tied up for 30 years. No. We're talking 24 to 36 months. Buy non-performing, working to rehab the borrower. Once they're back on track making payments, we're going to turn around and sell that note off and cash out of the deal. Okay. They're making 6 to 12% without having to do anything. It's a pretty good day. Like I say, flat interest rate loan agreements, not difficult to do. No joint venturing, no violating securities laws, selling CDs or selling certificates. Selling securities. That's not the thing we're doing here. Now, here's the thing you got to keep in mind. 33% of all self-directed IRA accounts, roughly, are at 0%. There's money sitting there not making them anything at all. Ouch. All balance sizes. Okay. Now, could this be one investor that funds the 350 for you? By all means, it could. Could it be 14? Yeah. It's not going to be anything greater than 14 because you're not going to pull people's money together. You're going to do one investor with 50K to buy one note and get rocking and rolling. Okay. Using your using an LLC as your main entity. Maybe it's a series LLC. Maybe you're setting up one or two LLCs for every 10 investors that end up funding the deal. Just that there's a variety of ways to do this. Okay. Now, let's recap. What are you getting? You're basically netting $375 a month after cash flow at 12 months times 14 deals is $63,000 in cash flow to you. Okay. You're collecting at least $2,000 of payments from the borrower, skin in the game. Hopefully, sometimes more. All right, but usually that's the minimum we're looking for. So that's times 14 deals. You're paying your investor 6 to 12% flat return on a $25,000 funding amount. Okay. You keep for cash flow or sell the reperforming note and cash out. That's the thing. If you're getting a great return on some of these deals, you may want to pay off the investor so that you keep the deal for yourself. Or if you've got them in at 10, maybe you get somebody at 6%, you refinance them out of their deal. Okay. You rinse and repeat and go and rock and roll. Now, here is basically a spreadsheet I put together showing you if you were to buy one note netting $375 a month to you. Okay, that's your net. And you did one per month for 24 months. Okay. One performing note. That's the same thing. Maybe it's not a non-performing note. Maybe you go find a performing note on a platform or in the Facebook group, or you get a list of notes sent to you from a lender who's willing to sell some stuff at a discount. It happens. Okay. But at $375 a month in 24 months, down here, 375 times 24 comes to $9,000 a month in monthly cash flow. Now, over this 24-month period, you would have also made an additional $108,000 in cash flow because it grows every month. It compounds. First month is 375. Second month is 750. Third month is 1125. Fourth month is 1500. If you're buying one note per month, this is not rocket science. This is not 40, 50 hours a week to find these types of deals. But we all know, ladies and gentlemen, how many of us are going to be around for at least 24 months? Well, most of us, right? A few of us are probably going to pass away or have something weird happen. But for the most of us, real estate investors don't die. All right. But this is how you build $9,000 a month in cash flow coming in on a monthly basis. If you did this for 4 years, that's quite a bit of chunk of money. That's 18 grand a month. That's 18 times 12 is enough. That's $216,000. That's just under $250,000 a year. And just on this is not them bringing anything extra to the table. This is not them paying you off or anything like that. Okay. This is just holding it for cash flow. Yes, we will have some notes that they refinance out, that pay you off. Will they go non-performing? Yeah, let's talk about that. Let's say you like to buy non-performance, which we're kind of talking about. And instead of you looking at the cash flow model, you'd like to make roughly 120K a year. I've had several students that come to me like, well, how do I make 100K a year? Well, you figure it this way. And this is from somebody who's been in the business for roughly about 20 years. If you're buying a mixture of performing and non-performing, your non-performing is going to kind of go a couple different ways. And unfortunately, not every non-performing note will reperform. I mean, if you stay in that higher profit range, higher profit, like if you're saying at 300 and above, most of the time, it's not going to be in your best interest to reinstate those guys and gals or modify or work with them in a forbearance plan. Your better bang for buck is probably going to foreclose on that because they're going to have a lower interest rate and it's be harder. So the profit margin on that, really the $250,000 loan and above, is really the foreclosure side. But under that, it can basically be reperformed. But let's say if you take 50% of the loans that you buy will reperform, they'll turn into monthly cash flow for you. The other 50% is going to be some sort of deed in lieu, cash for keys, or you foreclose. All right, you work with a borrower to get out of the property because they can't pay on time, they don't want to pay on time, or if they stick their head in the sands, or you find a property that the borrower's moved on, or a reverse mortgage, you just foreclose on the deal. Okay, that's just kind of a quick 50-50 aspect. Now we see it's higher about if we're buying occupied assets, it's going to be closer to 60-70% get reperforming, so that means 30 to 40% won't pay you to foreclose. It just adjusts by what you're doing. Now, if you're targeting vacant assets, guess what? You're going to foreclose probably 90% of the time and go that route. But if you're wanting to get 60K in cash flow annually to 5K per month to split this 120,000, so that's 10 on average, 10 grand a month. Remember, all right, you've got that cash flow. We talked about building those notes, okay? 60K in big checks means it's going to take you about 10. If you're getting 10 to 15K per deal minimum on the lower balance, I wouldn't do a deal where I could foreclose on it and make less than 10 grand. That's not a good sign. I prefer 20 grand, but if you're going to make 10 to 15 grand after your money costs and it's a pretty clean property, that means you're going to do 10 to 4 to 6 deals on the side. All right. And remember, we talked about the 60K cash flow in the previous slide. So that's 14 deals to get to that. So if you figure in, you buy 14 non-performing notes that get reperforming, plus 6 notes that you actually end up foreclosing on, that's 20 deals. Okay. Everybody who's watching this is capable of doing 20 deals this year. Now, whether you do or don't, that's completely up to you. All right. Completely up to you on what you do, how much you market. And of course, I don't have that much in private capital. Okay, that means you need to go out and market for private capital. You're going to dive into the postcard systems, the self-directed IRA system that we teach to connect with people. Okay, so that's 20 deals. Now, how many offers do you need to make to hit that 20 deal mark? Well, most students, most new people who've gone through our class and listened to what we say have about a 10% closing ratio to begin with. You make 10 offers, maybe you get 4 or 5 accepted, you end up closing on 1 because the due diligence kills everything else. So let's just assume a 10% closing ratio. Some will be higher, some will be lower. Okay. Well, 10% closing ratio 10% times 20 notes means 200 offers you need to make in 12 months. 200 divided by 12 comes out to 17 offers per month. That's 4 1/4 per week. So you need to make an offer about 1 a day. I mean, 1 a day is pretty easy. I mean, you may make 5 on Monday and that covers your whole week, but that's what I'm getting at. This is not, I got to make hundreds of offers every month. No. You make 17 offers per month. It's pretty feasible if you'll understand how to market and how to stand to reach out to things to make some things happen. Okay. Now, let me show you a way that you could do this right now. Okay. With a platform out there that, it's out there. Sometimes there's deals on there. Other times there's not deals on there. Okay. But we, in the spirit of making it easy where there's zero excuses at why you can't do this. All right. So we went over to an online platform that we downloaded what their available notes were available for. We got rid of some things off it, but after we got rid of the low interest rate, the low yields, we got rid of the offers of the properties that were non-performing or they didn't have a solid sales price. Like making offers great, but I wanted something that I could physically show you. And we also then got rid of higher assets that are over like a $500,000 in price. Okay. So when we narrowed it down from 140, 160, I don't remember exactly what it was, we narrowed it down to 57 performing notes. Okay. And they had the sales price. So out of those 57 performing notes, it's a 2.69 million sales price, which is at 77% of the loan to balance. Now it didn't have values on there. On these, a lot of these were newly originated loans in the last year. Some were land loans, but they were all performing and basically underwritten. I actually know some of the sellers. I actually am interviewing the seller of a chunk of them in a few minutes on the podcast. So basically, if you come in at what they want to sell these for, the firm or flexible price, flexible we'll get to in a second. It's a 3.5 million UPB, unpaid principal balance. Okay. Now, if you take the 57 loans and multiply the monthly P&I payment times 12, that's $658,000 in annual cash flow. Okay. Now, just taking the 658, subtracting, we'll just say $25 a month in servicing costs, because it's a performing note. You can do that in a couple different servicers. You take 658 minus, that's your net cash flow. Divide that by the 2.69 million sales price. That's a 24% ROI after servicing. Now, let me share you the spreadsheet. Let me go through this with you. I don't mean to blow you away, but, well, Scott, I don't have $2.7 million. I know you don't, but let's talk about how you can do this, okay? You've always heard the analogy, how do you eat an elephant? Well, one bite at a time and not the asshole in first, okay? But I can show you how to do this. This is not difficult. We've helped plenty of our students do this, and this is one of our focuses of doing this. This is why you can, it does, maybe you don't need to buy 57. Maybe you need to buy 10. Who knows? Or maybe you need to buy your first one to build some confidence in putting systems together for you. So let's go through. Let me bring up my spreadsheet here. All right. So I think this is it. All right. Just making sure you can see. Yeah. Okay. So this is all for sale. You can see the list prices on these are anywhere from like 49 all the way up to like 146. But there are a lot of like lot loans. Okay. And here you can go. You can see the performing, the unpaid principal balance, the interest rates all over the place. The interest rate on these is anywhere from 7% up to 15%. Okay. That's the interest rate, underlying interest rate of these loans. Yield is anywhere, if you just figure the yield is anywhere from 15 to 20.5% based on it. Now, the average term of this is 84 months. Oh, no, I'm sorry. The average term was actually less than that. You've got some all over the place, 56, 59. Yeah, 57-month average. Some are longer than less. But this we're talking, that's 5 years. Okay? You'll be in and out of these deals in 2 or 3 years, the way I teach you. Okay? But if you go over here, and I just add these numbers up. So 57-month average, if you take this, total UPB is 3.504 million. Okay? The sales price, if you add these up based off the website, is 2.7 million there. Okay, so 2.7 divided by 3.5 is 77% loan to balance. Okay. Now the average sales price, obviously, if you take 2.7, divide that by 57, there's 57 notes, not 58, because the first one there is that. So basically, average purchase price of these is 47 grand. 47 grand. Okay. All right. And you're at 77% loan to balance. Okay. So you got 23% of equity. So average is about 60 on these. So let's just do this here real fast. So I did not do that. Divide that by 57. So yeah, 61 is the usual average UPB on this. There's about $14.2 thousand difference between the sales price and this. So we're selling at a 23% discount on average across the board. Okay. Now, if you figure $57 loans times $25 a month in servicing costs, that's $14.25 a month in servicing costs that you're paying to the servicing company. Okay. Now, if you take the annual cash flow, all right, total cash flow, 674,960. Where did I pull that from? I went over here to the P&I payments. Here you go. Monthly is 56,246 if you add them all together. And payments on these are anywhere from 160 all the way up to 9,300. Because you have some big loans on some of this stuff here. Okay, let's see here. Make sure you get a big condominium there in Georgia. It's a big payment. Okay. We can even get rid of some of those off-brand ones so you can make it more vanilla. But I'm just saying, pretty simple. So taking that monthly cash flow, all right, total cash flow is $674,000, just under 675 net. After you remove your annual servicing costs, it's 657. 657 divided by the purchase price of 269 or 2.7 roughly is a 24% cash and cash return. Pretty good. Pretty stinking good. Okay. Now, a lot of these are flexible. So let's say you can negotiate an additional 10% discount on these. All right. 10% of what you're paying. So 2.69 means you're buying it for 2.425. All right. It's just under 79 or under 60. Sorry, under 70% loan to balance. Okay. That means 42,548 would be the average purchase. So it drops another 5,000 roughly off. Okay. So now you're at almost $20,000, 18,500, 18,600 in equity. Okay. Now, if you bought these at 2.4 million, your new ROI is roughly 27% on the gross side. Okay. After servicing and stuff like that. That's pretty good. Okay. Now, that's if you use your own money. You got 2.5 million sitting around. Here you go. Here's some opportunity for you. Okay. Now, if you don't have 2.5 million just sitting in your piggy bank, okay, that's fine. Let's say you got to pay money to your investor. So you are getting money at 8% interest. Let's just say that. 8% means you're paying off 8% on the 245. Let's see here, B67. Yeah. So you're netting 194. All right. I'm sorry, 194 is what you're paying your money. You're netting 463 on that deal annually. If you're paying 10%, you're paying 242. You're netting 415. You're paying 12%, that's 291. You're netting 366 on the cash flow. Now, let's take it back. Let's do a different thing. So this is at the 10%. Let's do it at normal amount. So let's just do here. We'll just copy this down. Boom, boom, boom. C is equal to, I didn't do the net is equal to, let's go here. Times 0.8. Yeah, that's right. Is equal to just the total sales times 0.1 is equal to the 269, 2.7 million basically times 0.12. So that's what you're paying, 323. You deduct that number from the cash flow. And there you go. So it's a little bit less. So if you are paying, you don't get the 10% discount, you're still paying 2.7 for the 57 notes, and you're paying 8% money, that's 442 net to you. 10% is still 388. 12%, it's almost a split right down the middle of 334. Do you see that, everybody, ladies and gentlemen? That's buying average one note at 42,548 average. Okay. Now, some of these, we could get rid of some of these definitely. If you want to go stay below that, great, we can stay below that. But you see these on average, most of these, the purchase prices, there's nothing greater, 144, 163, you got a couple larger ones on there. But you're getting a pretty good little discount there too for you. Everybody can go do this. All right. But it comes down to, if you have your own capital, guess what? Go put the money to work and make a phenomenal return on your investment. Okay. Hold these for a while, sell them all off. Now, one thing that you'd want to do, obviously, if you're buying this at 42, you like the bigger hit, like the bigger spread and the balance with it. You're going to have to pay your investor off in 2 to 3 years. So this is not for 30 years, but hey, guess what? I would be taking a chunk of the money that comes in and putting it to the side to pay off some of these higher valued assets, or continuously keep marketing. So as you get good investors that come in that like a lower, are happy with a lower term, 6 to 8, you can then sock that money aside and refinance out your more expensive investors. Okay. One thing you would definitely want to put in the funding agreement is that you have the right to refinance them out at any given time. Okay. And do that without a penalty. But their minimum investment is being in this, and I would say at least 24 months for you. Okay. And the thing that you'd want to go to is look at each note's amortization table to see, okay, we're buying it here. The balance is this right now. We're buying it below this. As they pay down, how many months do I have until that balance equals what I invested or I borrowed? And that's your kind of, you're like, hey, you got to get rid of it before now and then, or sell it back to them, give them complete cash flow, get them the whole payoff back to them. In a lot of cases, you could do that too. Okay. Any questions, any comments, any concerns about this type of strategy? I mean, this is not meant to be difficult, but ladies and gentlemen, you can all do this. Maybe it's not 57 at once, maybe it's not 20 at once, but maybe it's one a month. Maybe it's one just to get the ball rolling that's going to put some cash flow in your pocket. Because if you're making cash flow off other people's money, it doesn't matter whether it's 7, 8, 12% net. It's actually technically infinite. All right. And the confidence that you will build from closing on your first deal is so worth it. Just get the ball rocking and rolling. Pull the trigger. Now, look, I've had students that have bought small balance notes, $4,000, $2,000, $3,000, just because they were scared and they went out and did that. They're like, oh, I could do this. We put it with the servicing company. If the borrower doesn't pay, there's plenty of room there to foreclose. If you're buying some of these land notes, a lot of times the sellers may even put clauses if the borrower stops paying that they'll buy it back from you. And then you don't have to worry about having to go through the foreclosure process. You get paid, they go out and sell it to somebody else because they're in the development space, stuff like that. So something to think about for you, ladies and gentlemen. But that's what I wanted to go through with you today. We're just talking about how to make 6 figures as a note investor, show you a way to do it, show you it's not rocket science, okay? Everybody can do this if you just will market. And that means talking to IRA investors, getting out and networking, finding people. Because if you find a deal that's going to pay 20%, hey, put somebody into it at 12% for a couple years. You know, that's the thing to do, or a year, and see what happens. You know, it comes in from talking with people. The more you talk with people, the better off you're going to be in getting better interest rates. When I first left banking years ago, I approached a lot of my clients there that had CDs making 1, 2, 3, 4%, and started talking about making 12%, and they got scared. Like, oh, that seems risky, really risky in the stock. You know, I'm happy making my 4%. That was a big learning factors. I came across the top, and they sounded like they weren't educated in real estate. They weren't educated in note investing, and none of them wanted investment because they thought it was all 12% was too high, too risky, and go from there. So you guys, that's why talking with other note investors or talking with other IRA investors, going out and networking, going to your real estate clubs, networking, whether it's online or posting, things like that. Look, your success is all at your fingertips. It's up to you to dive into those deals and go make some stuff happen. Otherwise, if you don't take action, nothing's going to change. You're just going to be disappointed. So get off your ass, get off your keister, go out and take some action, and hopefully we'll see the top. Thank you for listening. Thank you for joining in. Thank you for the comments and questions, guys. I highly encourage you. Come on out to Austin in 2 weeks here, the February 14th, 15th, and 16th. We have our 3-day workshop live in person here. We don't do these very often. We may do a second one this year back in next August, but come on out Valentine's Day and we'll show you how to fall in love with note investing. Go to notebuyingfordummies.com, get signed up. There's still a discount code. Get signed up today before it goes away. Otherwise, we'll